You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
We're surrounded by micro and macro investment themes, and here to help us sort through them and attach actionable trades to them is Sylvia Jablonski. She's Managing Director at Direxion Investments. They've got $14 billion in assets under management in 90 ETFs. Sylvia, welcome to the program. Always great to catch up with you.
Hi, Ron. Thanks so much for having me. Glad to be here.
So compared to the rest of the world, and I know you've been watching this, the U.S. stock market is outperforming, and that's been good for traders in Direxion ETFs that offer 2 times and 3 times exposure to U.S. benchmarks tied to the S&P 500, ticker symbol SPUU, and then SPXL. So why are U.S. stocks doing so well on a relative basis?
Well, that's a great question. So if you look at, the U.S. versus international, there is a slowdown essentially globally in both regions, but the U.S. is holding up a little bit better than some of its international counterparts. And I think a lot of the reason why has to do with some of the continued themes, like the consumer is strong, the consumer continues to hold us up, the consumer is purchasing goods and services and homes. The jobs numbers remain pretty strong. In the first half, 3.5 jobs number continues to be a multi-decade, positive number. We have a supportive Fed. We have growing GDP, albeit slowing GDP. The first half gave us a 2.5 GDP. When you compare that to Europe, the IMF is expecting a 1.2% GDP there. It's substantially different, really, that our economy continues to sort of keep puttering along, even with some of the risks out there, like the China trade tariffs and China trade wars. To that, we've seen about 1.3 billion of outflows from some of the international ETFs out there. And meanwhile, billions of inflows into the U.S.-related ETFs, which is sort of a record high. And, S&P 500 is right now sitting again at close to a record high, and international indices are close to record lows. When you look at the ETFs that you mentioned specifically, SPUU, the 2-beta S&P 500, and SPXL, the 3-beta S&P 500, those daily funds, they're up respective 41% for the 2-beta, 63% year-to-date for the 1-beta. That's essentially compared to the 3-beta developed ETF, it's outperforming by about 20%. And really, I do think it's the consumer, it's the strong jobs, and it's the supportive Fed, and, at least although volatile, continued optimism that we get some sort of trade deal with China done, whereas Europe has, sort of none of those 3 things, and on top of that, some political angst with Brexit and such.
Sylvia Jablonski, Managing Director at Direxion Investments, is with us. Now, nearly every S&P 500 industry sector has registered a double-digit year-to-date gain. One that has not is healthcare stocks. And for a long time, healthcare has been a leader. Now it's a laggard. And it's also, I think, a contrarian trade because of that. Ticker symbol CURE, C-U-R-E, aims for 3-beta or 3x daily bullish exposure to healthcare stocks. It's still a promising sector. Please remind us why.
Yeah, I actually, interestingly enough, I know, you and I were talking about this particular topic, and I actually really loved healthcare. I think that it's a very interesting sector to look at because, like you said, it's a contrarian play. You've got 70 million baby boomers out there that are aging. It's the second cheapest sector right now. There's some great strengths in simply the population of people that will need to absorb healthcare. And, the risk has always been sort of political and what will happen with the election. But if you sort of watch some of the debates right now, it seems like Medicare might not exactly be the way that either side wants to go right now. So, if that sort of starts to feel like it's off the table and you've got, the population issue and you've got, some of these names like Bristol Myers, Medtronic, UNH just had pretty good earnings. If some of this holds up, I think people will definitely look at this sector. So, just to give you a sense of performance, month to date and year to date on some of these. So Cure is a 3 beta healthcare ETF, and year to date it's up 20%. Biotech is up about 7%, and our pharmaceuticals ETF is up about 13%. And of course, past performance doesn't indicate future performance, as we all know. But I do think that late cycle performer, and it's sort of well poised. A lot of these healthcare companies have strong balance sheets. They pay decent dividends, and again, there's this massive merger going on and rotation from pharmacies, retail pharmacies, minute clinics to biotech companies to health insurance, all sort of merging and finding better and cheaper ways to do things. I think it'll definitely be something that's worth looking at in the coming years in terms of investment ideas.
Let's talk about relative weight trades where investors can favor specific themes over others, and Direxion has a suite of these types of ETFs. Let's focus on the Direxion Russell 1000 Growth Over Value ETF. That's ticker symbol RWGV. It's gained almost 20% year to date, and growth stocks have indeed outperformed value stocks in 2019. Does that surprise you?
So it doesn't surprise me, mainly because if you look at the past decade, growth has outperformed value. Growth has been up about 16% annualized versus value 12%. Our growth over value relative weight ETFs that you just mentioned since inception, which was January 16th, has been up about 21%. So, why I like growth, or why growth I think continues to perform is it's simply that growth remains in the driver's seat. September showed us that value can certainly come into favor, during a period of time where we hear volatility and perhaps China tariffs and fears of a hawkish Fed. But, that story was very short-lived, and growth kind of came back. So I think earnings will be really important right now. We'll need to see that these growth names are not just high multiples, but they're actually growing based on fundamentals, and we're starting to see a little bit of that with Intel and Microsoft and some of the other technology growth names, which I think are about 11% of the major growth ETFs. I think you have the accommodative Fed keeping borrow rates really low, which helps those companies borrow and continue to grow. And again, just to give you some color, in the first 8 months of the year, 2.46 billion of creates were done in various growth ETFs, and about 2.6 billion redeems came about in value ETFs. So I do think that a lot of portfolio managers and investors out there are worried and a little bit trepidatious about the market, and think that maybe there's sort of, we're at the end of the game and the rotation will happen. But the fact is, it simply just hasn't happened yet. And with amplified exposure to growth, investors have done quite well in recent history. And the way that the relative weight trade works is you basically get 150% weight to growth and a negative 50 weight to value. So you have 100%, sort of market beta exposure. So it's like a 1 beta fund more or less in terms of your leverage exposure. But what it does is it offers investors amplified exposure to companies with high forecasted earnings, namely growth names. So if growth continues to surprise us and sort of, or at least meet expectations this earnings season, I think it'll probably continue to run a little bit longer.
One last question, Sylvia, before you take off, and we got another minute. The expansion of commission-free trading with ETFs by large online brokers is here to stay, and that's been celebrated by everyone, including us. But it's more than just cost savings to the investor. It's also about flexibility and more choice. ETF investors are no longer constrained by limited menus because all ETFs now trade without a commission. What are your thoughts?
Yeah, Ron, I think it's great. I think it's great for people like us. When we make our own trade decisions, we can simply, pick the ETF that suits us best. What I do think will happen, though, is, interestingly enough, there's this, fee compression, this war to zero fees. So if you have no fees trading and you have, no fee ETFs on top of it, investors certainly have the ability to pick what they want in a very cost-efficient way. And I think it makes their due diligence job a little bit easier. But hopefully, they still sort of give credit where credit's due, where some of the ETFs that are expensive but worth it are still considered.
Amen. You just heard from Sylvia Jablonski, Managing Director at Direxion Investments. Go there, DirexionInvestments.com. That's DIREXION investments.com. I'm Ron DeLegge. This is the Index Investing Show. More when we return. Go nowhere.